Ever looked at a company's financial report and wished someone could just translate it? Or maybe wondered how businesses make sense of just mountains of data to make those big decisions? Like our friend Lisa, who just launched her dream artisan bakery, The Daily Loaf. She's got amazing bakers, loyal customers. But when her accountant hands her a pile of spreadsheets, she just sees numbers, not the story of her business. Today, we're doing exactly that, giving you and Lisa the toolkit to decode the language of business performance. We'll start with the traditional stuff, financial statement analysis, those critical numbers on the page, and then move all the way to the cutting-edge realm of data analytics, where all that raw information truly speaks volumes.
Yeah, it's going to be an incredibly insightful deep dive because what we explore today, it provides such powerful clarity into any organization. Doesn't matter if it's a huge corporation or, Lisa's growing bakery. Understanding these tools isn't just for investors or finance gurus. It's really for anyone who wants to grasp the true health and potential of a business. Helps you spot opportunities or maybe red flags long before they become, well, undeniable.
Okay, let's unpack this then. We're talking about financial statements, the income statement, balance sheet, cash flow statement. For someone like Lisa, they can seem like this dense collection of numbers. So what exactly is financial statement analysis, and why are these ratios so important in making sense of it all?
That's a fantastic starting point. At its core, financial statement analysis is really about taking those complex, sometimes overwhelming financial documents and distilling them down into understandable, actionable insights. And you're right, ratios are absolutely key here. Think of them like special magnifying glasses. They're quantitative financial indicators, right? They show the relationship between selected items on a company's financial statements. So instead of seeing isolated numbers, ratios let you see how different parts of the business actually connect.
Okay, that makes sense. But why are they so important? What do they let you do?
Right, because they allow for powerful comparative analysis. Imagine Lisa looking at her bakery sales. A single number, say $100,000 in sales, doesn't tell her much on its own, does it?
No, not really.
But if she compares it to last quarter, or maybe to what other bakeries in her city were doing, then she gets context. Ratios let you do exactly that. You can compare an entity's performance over different periods, say year over year, to identify crucial trends. You can also compare a company's ratios against its direct competitors, or even against overall industry averages, just to see how you stack up.
Ah, okay. So it's all about context and comparison.
Exactly. These comparisons are vital for investors deciding where to put their money, for lenders assessing risk, and frankly, for any interested party looking to truly understand an organization's health. They help you spot patterns, identify strengths, and pinpoint potential issues. Now, we tend to classify these key financial ratios and metrics into four high-level categories. Each one gives you a sort of distinct lens to evaluate a company's strength and performance.
Four categories. Okay, what are they?
First up, we have profitability ratios. As the name suggests, these measure how successful a business is at generating profit over a period. Pretty straightforward. Then there are liquidity ratios. These look at a company's short-term ability to meet its immediate financial obligations, like can they pay their bills next week?
Short term. Okay.
Then moving to the longer view, we have solvency ratios. These measure the long-term security or protection a company offers its creditors and investors, essentially. Can they survive for years to come?
Gotcha. Long-term survival.
And finally, we have performance metrics. These evaluate both operational efficiency and how the company's stock is doing from an investor's point of view. Each category helps an analyst or, any stakeholder determine if a company's performance is improving or maybe trending unfavorably, guides you on where to dig deeper.
That makes so much sense. But before we dive into the specifics of each of those, one thing I've always found a bit tricky is understanding how these ratios actually change when a company's numbers shift. Like, if sales go up, what happens to the ratio? Is there a simple way to think about that, especially since, we don't have visuals for our listeners?
That's a brilliant question. And yeah, it's something that can really trip people up initially. But once you grasp this foundational concept, analyzing ratios becomes much, much easier. Think of any ratio as just a simple fraction. One number, the numerator, divided by another number, the denominator. Simple math, right?
Numerator over denominator.
Exactly. The key principle here is that the numerator has a direct relationship with the ratio's result. So if the numerator increases, the ratio itself will also increase, assuming the denominator stays the same. Imagine a basic ratio, say 10 divided by 2. That gives you 5.
Right.
Now, if the numerator goes up to 12, but the denominator stays at 2, you've got 12 divided by 2, which is 6. The ratio increased from 5 to 6. Direct relationship.
Okay, numerator goes up, ratio goes up. Got it.
Now, the denominator has an inverse relationship. So if the denominator increases, the ratio will actually decrease, assuming the numerator stays the same. Let's use our example again. 10 divided by 2 is 5. But if the denominator increases to 4 and the numerator stays at 10, now the ratio becomes 10 divided by 4, or 2.5.
So it went down. Inverse relationship.
Precisely. The ratio decreased from 5 to 2.5. It's moving in the opposite direction. Now, this is pretty straightforward when only one part of the fraction changes. But what happens if, say, both the numerator and the denominator are affected by some business event?
Yeah, that sounds tricky. How do you figure that out?
That's where it can get a bit confusing to figure out the final result just by thinking about it abstractly. For those more complex situations, the best, most practical tip is honestly really simple. Just make up some easy numbers that reflect the change, plug them into the formula, and calculate the result.
Just test it out with simple numbers.
Exactly. It'll immediately show you whether the ratio is going up or down. It's a pragmatic approach, makes complex analyses much more manageable, especially when you're just starting out.
Okay, so armed with that understanding of how ratios move, let's start with what most people immediately think about when looking at a company. It's profitability. Is it actually making money? And, importantly, how well is it doing that? This category of ratios gives us those answers. Right. If Lisa's looking at her bakery, this is probably the first thing on her mind.
Absolutely. Profitability ratios are all about measuring the financial success of an enterprise over a given period. They tell us how effectively a company is converting its sales into actual profit, which, for Lisa, means how much she gets to keep after selling all those delicious loaves and paying her costs. First up is the gross profit margin. This simply tells you how much money is left over from each sale after paying for the direct costs of the goods you sold the ingredients, basically. It's essentially your revenue minus the cost of your products, expressed as a percentage.
Okay, so revenue minus direct costs as a percent.
Right. So if Lisa's The Daily Loaf has, say, a 44% gross margin, it means for every dollar she sells, 44 cents is left over. That 44 cents then has to cover all her other costs, like rent, salaries, marketing, and hopefully leave some actual profit at the end. Let's look at G Company. In year 2, their gross profit margin was 44.44%. That was actually a slight dip from 44.71% in year 1.
A small drop. Is that bad?
Well, it's an immediate signal. You'd want to ask why. Is it because their raw material costs, flour, sugar, eggs for Lisa, increased significantly? Or maybe they had to lower their selling prices because of new competition? Generally, a higher margin is better. It indicates greater efficiency in managing those direct production costs. Companies often forecast their cost of goods sold, or COGS, as a consistent percentage of sales to try and keep this critical margin stable. It's really the first ripple in the pond of profitability.
Okay, so gross margins is the first cut. What's next?
Next, we look at the profit margin, often called net profit margin. This ratio zooms out further. It tells us how much profit a company makes for every dollar of sales after accounting for all expenses. That includes operating costs, interest on loans, even taxes. It's the bottom line, really. For G Company, in year 2, this was 11.11%, which was actually up from 10.59% in year 1.
Oh, interesting. So their gross margin dipped slightly, but their net margin went up.
Exactly. That's a positive sign. It suggests that even though their direct costs might have gone up a bit relative to sales, G Company managed its other expenses, interest, and taxes more effectively. So they ended up with a higher percentage of profit per dollar of sale overall. A higher net profit margin is always desirable because it signifies strong overall profitability. For Lisa, this tells her what percentage of her bakery's total revenue actually becomes her take-home profit. It's a critical measure when making projections, heavily influencing future decisions about debt or equity and potential stock growth if it were a public company.
Got it. So net profit margin is the bottom line percentage. What else is in this category?
Then there's return on sales, ROS. This measures how much profit a company generates from each dollar of sales before considering the impact of financing costs like interest and taxes. For G Company in year 2, their ROS was 17.39%. This gives a clearer picture of just the operational profitability, isolating it from how the company is financed or its specific tax situation.
So it's a cleaner look at the core business.
Exactly. How efficiently the core business generates income from sales before finance and tax effects. Moving beyond just sales, we have return on assets, ROA. This ratio answers a different question. How efficiently is a company generating profits from all the resources it owns, its assets?
Assets, like buildings, equipment, cash.
Yeah, all of that. Property, equipment, inventory, cash, receivables, everything the company owns. For G Company in year 2, their ROA was 7.19%. A higher ROA indicates better asset utilization. It means the company is making more money from the stuff it possesses. If Lisa, for example, invests in a new state-of-the-art oven, she'd really want to see her ROA go up over time, signifying that her new asset is truly helping her generate more profit. When forecasting, projected net income is often compared to projected assets to see if this ratio is expected to increase or decrease in the future. It's a key planning metric.
Okay, ROA is profit relative to assets.
Yeah.
You mentioned a DuPont formula. What's that about?
Ah, yes, the DuPont return on assets. This is a really insightful way to break down ROA. The formula is profit margin multiplied by asset turnover. For G Company in year 2, this was 11.1%, the profit margin, times 0.65 times their asset turnover, giving roughly 7.22%, which matches the direct ROA calculation, maybe a slight rounding difference. The power of this DuPont formula lies in its ability to disaggregate ROA into its two key drivers.
Profit margin and asset turnover.
Right. The profit margin shows the percentage return on each sale, and the asset turnover indicates how effectively assets are used to generate those sales. This breakdown allows for a much deeper analysis of why ROA might be changing. Is it because the company is more profitable per sale, or because it's using its assets more efficiently to generate sales, or both? It helps you pinpoint the exact levers of change.
That's really useful for diagnosing performance changes. What about returns for the owners?
Excellent point. That brings us to return on equity, ROE. This is a critical one for investors because it directly measures the return generated for the shareholders, the owners of the company. It shows how much profit the company makes for every dollar of shareholder equity. For G Company in year 2, their ROE was 14.18%. A higher ROE is generally very desirable. It means greater profitability for the owners, which often translates to higher earnings per share and probable future stock growth.
And you mentioned using average equity in the denominator. Why average?
Good catch. We typically use average equity because net income is earned over an entire period, right? Like a full year. But the balance sheet, and thus the equity figure, is just a snapshot at a single point in time, like December 31st. Averaging the equity at the beginning and end of the period gives a more representative figure for the equity base that was actually used to generate that income throughout the period. It gives a fairer comparison.
Makes sense. One more, profitability ratio.
Yes, the operating cash flow ratio. This one is vital for understanding a company's immediate financial health from a cash perspective, not just accounting profit. It's calculated as cash flow from operations divided by current liabilities. For G Company in year 2, it was 0.40, a slight increase from 0.38 in year 1. This ratio indicates how much cash a company generates from its core business operations to cover its immediate liabilities. A higher ratio is preferred. It signifies strong internal cash generation.
So this is about real cash coming in from the main business.
Exactly. Positive and sustainable cash flows from operations are absolutely critical for a company's long-term success. If Lisa's Bakery suddenly saw its operating cash flow ratio decline, that would be a huge red flag. It might suggest she's having to rely on less sustainable sources, like selling off equipment or taking out more loans, just to cover her short-term needs. This is why it's so important. Cash, after all, is king.
Okay, so profitability tells us if they're making money. That's great. But I've heard stories, profitable companies going bankrupt. How did that even happen? What's the missing piece here? Because for someone like Lisa, she might be selling thousands of loaves, showing a profit on paper, but if she can't pay her flour supplier on time, she's in deep trouble. This is where liquidity comes in, right? It's all about whether a company has enough cash or assets that can quickly become cash to cover its short-term debts.
You've hit on a crucial paradox there. A company can be profitable on paper, but if it lacks the actual cash to meet its immediate obligations, it faces severe problems. And this is precisely what liquidity ratios address. They are specifically designed to measure a firm's short-term ability to pay its maturing obligations. They're crucial for assessing immediate financial viability, making sure a company can keep its doors open tomorrow.
Okay, so what's the first liquidity ratio we look at?
Let's start with the current ratio. It's probably the most common one. It's simply current assets divided by current liabilities. For G Company in year 2, it was 1.03. That was slightly down from 1.09 in year 1. Now, importantly, the industry average for this ratio is 1.50.
1.03 versus 1.50. That sounds low.
It is. G's ratio is clearly lower than the industry average, which strongly suggests they might face some difficulty in meeting their short-term obligations. Generally, a higher current ratio is better because it implies that more current assets, things like cash, accounts receivable, and inventory, are available to cover those short-term liabilities like accounts payable and short-term loans. If Lisa anticipates that her current assets might decrease, Maybe customers are paying slower, or her current liabilities might increase. Perhaps she took on a new short-term loan. It will lead to a lower forecasted current ratio. This could negatively impact her ability to get future funding or even just buy ingredients.
So current ratio includes everything current. Is there a stricter measure?
Yes, there is. It's the quick ratio, also known as the acid test ratio. This focuses only on truly liquid assets. It takes cash and cash equivalents, plus short-term marketable securities, plus accounts receivable, and divides that sum by current liabilities.
What's missing there compared to the current ratio?
Inventory. Notice inventory is excluded here. Why? Because inventory might not convert to cash quickly. You have to sell it first, right?
Selling takes time.
For G Company in year 2, their quick ratio was 0.61, down from 0.70 in year 1. The industry average for the quick ratio is 0.80.
Again, lower than the average, 0.61 versus 0.80.
Exactly. Like the current ratio, G's quick ratio is also lower than the industry average. This again indicates potential issues in meeting immediate needs as they don't have enough highly liquid assets to quickly cover their short-term bills. If you project shifts from highly liquid current assets like cash to less liquid ones like inventory, or increases in current liabilities, this ratio will naturally go down, making a company look less capable of weathering a sudden cash crunch. And here's a specific insight, kind of passkey, if you will, related to this.
Okay.
When a company uses current assets, say cash, to pay down current liabilities like accounts payable, what happens? Both the numerator and the denominator of both the current and quick ratios decrease by the same amount.
Right, both go down by the same number.
What's often overlooked is that if the ratio is already less than 1 to begin with, this action of paying down debt will actually further lower the ratio.
Wait, really? Paying debt makes the ratio worse if it's already below 1.
Yes, mathematically. So a company trying to improve its situation by paying down debt might inadvertently make its key liquidity ratios look even weaker in the short term if they were already below that 1.0 threshold. It's a counterintuitive but important point to remember.
Wow, okay. That's definitely tricky. What other liquidity ratios help?
Well, we need to look at how quickly specific assets are converting to cash. Let's start with accounts receivable turnover. That's calculated as net sales divided by average accounts receivable. For G Company in year 2, this was 5.22 times. This ratio measures how many times, on average, receivables are collected during an accounting period, usually a year. A higher number generally means they're collecting their money faster.
Okay, 5.22 times a year. What does that mean in days?
That's exactly what the next ratio tells us. Days sales and accounts receivable. The formula is ending accounts receivable net sales divided by 365. Basically average daily sales. For Jai Company in year 2, this was 60.83 days. This measures the average number of days it takes for a company to collect payment after making a credit sale. So Jai Company takes about 60 days, 2 months, to collect on its credit sales.
So these two AR ratios work together.
Absolutely. They are fantastic measures of the effectiveness of a company's credit and collection policy. Fewer days are usually ideal, means faster cash in hand. But if a company's policy is too strict, demanding immediate payment, they might lose out on sales to competitors who offer credit. On the flip side, too many days indicates struggles in collecting from customers, which ties up valuable cash. It's a balance.
Okay, that covers collecting from customers. What about inventory?
Right. Inventory is another big current asset. We measure its efficiency with inventory turnover, cost of goods sold divided by average inventory. For G Company in year 2, this was 3.54 times. This measures how quickly inventory is sold during the year. Generally, a higher turnover indicates better performance.
Why is higher better?
Because it means inventory isn't just sitting idle on shelves or in a warehouse. Idle inventory risks becoming obsolete, damaged, or simply incurs storage costs without generating revenue.
And the D's version of that.
That's days in inventory. Ending inventory divided by cost of goods sold divided by 365. Basically, average daily cost of goods sold. For G Company in year 2, this was 105.85 days. This is the average number of days inventory is held before being sold. So G's inventory sits for over 100 days on average.
Wow, this seems like a long time.
It can be, depending on the industry. These two inventory ratios measure the effectiveness of a company's inventory management. For Lisa, if her bread sits in the bakery for too many days, it goes stale, right? Quickly converting inventory to sales is good, but again, there's a balance. Too many days can lead to obsolescence or spoilage, but be careful. Too few days might mean the company doesn't have enough stock to meet sudden sales demand, leading to missed opportunities.
Okay, receivables and inventory. What about the bills the company owes in the short term? Payables.
Good point. We also examine payables. The accounts payable turnover is cost of goods sold divided by average accounts payable. For G Company in year 2, this was 7.27 times. This ratio indicates how many times trade payables turn over during the year. A low turnover might signal delayed payments, possibly due to cash shortages. Or it could mean they are strategically taking longer to pay their suppliers to hold on to cash. Which brings us to the next ratio. Days of payables outstanding. Calculated as ending accounts payable divided by cost of goods sold divided by 365. For G Company in year 2, this was 54.75 days. This measures the average length of time trade payables are outstanding before payment. So G takes almost 2 months to pay its suppliers on average.
And these AP ratios tell us.
These two AP ratios assess how effectively a company is attempting to delay payments to its creditors. This can be a conscious strategy to conserve cash. Delaying payment is good for cash flow up to a point, but again, balance is key. If the period is too short, the company isn't fully utilizing its cash advantage. If it's too long, it risks harming crucial relationships with its vendors. They might start demanding upfront payment or even refuse to supply you.
Okay, so we have days to collect receivables, days inventory sits, and days to pay suppliers. Is there a way to combine these?
Yes, there is, and it's a really powerful summary measure. It's called the cash conversion cycle, CCC. This tells you how long your cash is tied up in your operations, from paying for inputs to getting cash back from customers. It's calculated as days sales and accounts receivable plus days in inventory, days of payables outstanding.
So days AR plus days inventory days AP.
Exactly. For G Company in year 2, this was 60.83 days plus 105.85 days, 54.75 days, which totals 111.93 days. This ratio indicates the average length of time it takes from when the company pays cash for an inventory purchase to when it finally receives cash from a sale.
112 days. That's almost 4 months for their cash cycle. Is that good or bad?
Well, the goal is always to minimize this cycle. Lower is always better. A shorter cycle means you get your cash back faster to reinvest. You want to convert inventory to cash quickly, low days inventory, and collect from customers quickly, low days AR, while strategically delaying vendor payments, high days AP, but not too high. For Lisa, a shorter cash conversion cycle means she gets her money back faster to reinvest in more flour and yeast, keeping her business growing smoothly.
Can you quickly recap the implications of each part of the CCC?
Sure. Day sales in AR. Fewer days are usually ideal for cash flow, but if collection policies become too strict, it could cost the company sales. Too many days signals challenges in collecting from customers. Days in inventory. Quickly converting inventory into sales is a sign of efficiency. However, if inventory sits for too many days, it risks obsolescence or spoilage. But too few days might mean not enough stock to meet potential sales demand. Days of payables, outstanding. Delaying payment to vendors conserves cash, a smart move. But if the period is too short, the company isn't fully utilizing its cash advantage. If it's too long, it risks harming crucial vendor relationships. It's a delicate balance across all three.
That's a truly comprehensive look at short-term health. It sounds like managing these immediate cash flows and operational cycles is a constant balancing act. Very tricky. But what about the really long-term stability? Can a company weather big storms, major economic downturns, or even just expand confidently into the future? That's where solvency comes in, right? It's about the company's ability to meet its long-term financial commitments, not just next month's bills.
Exactly. Solvency ratios are measures of security or protection, primarily for long-term creditors and investors. They tell us about a company's financial structure and its fundamental capacity to meet its long-term debt obligations, basically ensuring its survival and ability to grow for years to come.
Okay, so what are the key solvency ratios?
First, probably the most well-known is the debt-to-equity ratio. This is calculated simply as total liabilities divided by total equity. For G Company in year 2, this was 0.91. That was down from 1.04 in year 1.
So less than 1 now. What does that mean?
It relates the two major categories of a company's capital structure. How much is financed by debt versus how much by shareholder equity. It indicates the degree of financial leverage being used. Generally, a lower ratio implies lower financial risk, as the company relies less on borrowed money compared to shareholder funds. The fact that G Company's ratio decreased from 1.04 to 0.91 is a good sign. It means they're becoming less reliant on debt relative to equity. For Lisa, if she were to consider a big loan to open a second bakery, this ratio would tell a potential lender how much of her existing business is already financed by debt versus her own investment. It's a key risk indicator for lenders.
Okay, debt relative to equity. What's next?
Closely related is the total debt ratio, total liabilities divided by total assets. For G Company in year two, this was 47.78%. This ratio indicates the proportion of a company's assets that are financed by creditors' debt.
So almost half of G's assets are financed by debt.
That's right. In G's case, approximately half of its assets are debt financed. A lower ratio here suggests greater solvency and a stronger ability to pay debts in the long run. If this number is too high, it signals a potentially risky reliance on borrowing, which can make a company vulnerable during economic downturns or if interest rates suddenly rise.
Got it. Debt relative to assets. Any others looking at leverage?
Yes, the equity multiplier. This is total assets divided by total equity. For G Company in year two, this was 1.91, down from 2.04 in year one. Now remember the basic accounting equation. Assets equals liabilities plus equity. So if you rearrange that, assets, equity, liabilities plus equity, equity. This means a higher equity multiplier essentially indicates that a greater percentage of the firm's assets are financed by debt relative to equity. It's another way to look at financial leverage.
So higher multiplier means more debt.
Exactly. The higher the multiplier, the more debt is being used relative to equity. A decrease, as seen with G Company, from 2.04 down to 1.91, indicates a reduction in financial leverage, which generally means lower long-term risk.
Okay, those cover the structure. What about actually paying the interest on that debt?
Crucial question. That's measured by the times interest earned ratio, often called TIE. This is calculated. Year two, this was 31.3 times.
31 times. That sounds really high.
It is. This ratio is a critical measure of a company's ability to comfortably cover its interest charges on its debt. A higher number indicates a greater margin of safety. It means the company has plenty of operating income to pay its interest obligations without any strain. A ratio of 31.30 times means G Company's earnings before interest and taxes are over 31 times greater than its annual interest payments. That's incredibly strong and signals very low risk for its lenders regarding interest payments.
So we've looked at profitability, liquidity, and long-term solvency. That feels like a really powerful trio for understanding a business's overall health. But finally, how do we look at a company's performance specifically from the perspective of current and potential investors? Because ultimately, a business needs to deliver value to its owners, right? It's about more than just staying afloat or paying bills.
Absolutely. Performance metrics are specifically designed to evaluate a company's operating performance and also elements of its stock performance directly from the viewpoint of investors. This is where we see if the business is truly creating wealth for its owners.
Okay, what are some key performance metrics?
Let's start with EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. This is a very common measure of operational performance. It's often seen as a proxy for the cash generated from a company's core operations before considering financing decisions, interest, accounting practices, depreciation and amortization, or tax strategies.
So it strips out a lot of non-operational or non-cash stuff.
Exactly. It helps cut through the noise of non-cash expenses like depreciation and amortization to see how much cash the business is actually generating from its fundamental operations. For G Company, both ways of calculating it yield $343,030 for year two. It's meant to be a raw, clean look at operational earnings power.
Okay, EBITDA. What's next for investors?
Next is earnings per share, EPS. Very important one. This is calculated as income available to common shareholders divided by the weighted average common shares outstanding. For G Company in year two, this was $200,000 divided by 100,000 shares, giving us $2 per share. EPS is a crucial metric for investors because it shows the portion of a company's profit that is allocated to each outstanding share of common stock. It's a direct, easily comparable measure of profitability on a per-share basis. When Lisa tells her friends about her bakery's success, she might intuitively think about her personal earnings, which is conceptually very similar to EPS for a larger, publicly traded company.
Right, profit per share. How does that relate to the stock price?
That brings us to the price-to-earnings ratio, PE ratio. This is simply the market price per share divided by the basic earnings per share, EPS. For G Company in year two, if the stock price was $12, you'd take $12 divided by the $2 EPS, resulting in a PE ratio of 6. This statistic indicates the investment potential of an enterprise, or at least how the market perceives it. A rise in this ratio generally suggests that investors are optimistic about the firm's future growth opportunities and are willing to pay more for each dollar of current earnings.
So a higher PE means higher growth expectations.
Often, yes. A high PE ratio implies strong growth expectations, while a lower one might suggest slower growth prospects, or perhaps that the stock is currently undervalued by the market. It's a key valuation metric.
What about dividends? Do investors care about getting paid directly?
Definitely. That's measured by the dividend payout ratio. This can be calculated as cash dividends paid divided by net income, or more simply as dividends per share divided by earnings per share. For G Company in year 2, their dividend payout was 40%. This ratio indicates the portion of current earnings that are being paid out to shareholders as dividends. It shows how much of its profit a company is returning directly to its investors versus how much it's retaining for reinvestment back into the business for future growth.
So 40% paid out, 60% reinvested.
Correct. A higher payout is often attractive to income-focused investors, while a lower payout might indicate a growth company that believes it can generate better returns by reinvesting heavily in its own operations.
Okay, one last performance metric.
Let's circle back briefly to asset turnover. We mentioned it with the DuPont formula, but it's also a key standalone performance metric. It's net sales divided by average total assets. For Jai Company in year 2, this was 0.65 times. This ratio is a strong indicator of how effectively a company uses its assets to generate sales revenue. A high ratio suggests efficient asset utilization, meaning the company is generating a good amount of sales volume from its asset base. For Lisa, if her bakery's asset turnover is low, it might suggest she has too much unused equipment or perhaps too much inventory sitting around not generating sales quickly enough.
This is a lot of powerful tools. We've just gone through a really deep dive into how financial ratios can tell us so much about a company's health, profitability, liquidity, solvency, investor performance. But as always, ratios aren't the whole story, are they? There must be limitations to consider and maybe other ways to look at those financial statements.
That's an extremely important point to make. While ratios are relatively easy to compute and can be incredibly insightful, they absolutely depend entirely on the reliability of the underlying data. And that data often includes estimates like bad debt expense, historical costs, which might not reflect current value, or fair value assessments, all of which are subject to judgment and can change. So yes, ratios alone aren't a standalone solution. They are just one piece of a much larger analytical puzzle.
So what else should we look at?
That's why complementary analyses are so valuable, for instance, horizontal analysis. This involves looking at the dollar and percentage change of financial statement items over a period of time, like comparing this year's revenue to last year's. This is immensely useful for evaluating trends and noticing significant changes from period to period, giving you a dynamic view. That helps answer, how has this number changed over time, and by how much?
Okay, looking across time, what's the other one?
The other main one is vertical analysis, which is helpful in reducing statement items to a common size. For example, on the income statement, all elements can be expressed as a percentage of total sales revenue. On the balance sheet, everything might be shown as a percentage of total assets. This common size format not only assists in period-to-period comparison for the same entity, but also allows for much easier comparability among different entities regardless of their absolute size, because everything is presented on a proportional basis.
So you can compare a huge company to a smaller one more easily.
Precisely. It helps answer questions like, what percentage of sales is cost of goods sold? Or what percentage of assets is inventory? These methods provide critical context to the ratio analysis, painting a much more complete picture of a company's financial situation.
Okay, here's where it gets really interesting, I think. If financial statements are those refined, structured numbers we've just spent so much time dissecting, then data analysis is how we make those numbers truly sing, and how we find even deeper insights in all kinds of information, not just the traditional financial reports. So to start, what kinds of data are we even talking about when we say data analysis? Where does it all come from, and what forms does it take? It feels like data is everywhere now.
That's a great question, because you're right, the raw material, the data itself, comes from incredibly diverse sources these days. We broadly categorize these sources as either internal or external. Internal data is generated right there within the organization. This can happen manually, like someone keying in a sales order for Lisa's Bakery. Or it can be created automatically, like system logs from a website server tracking clicks, or maybe data from electronic data interchange EDI, which is basically when computers talk directly to other computers. Like one company's ordering system automatically sending a purchase order to a supplier's system without a person involved.
Okay, automated computer-to-computer stuff.
Right. And then there's semi-automatic data, like maybe an employee reviewing a sales order record that was initially created using optical character recognition, or OCR, which scans text from images, like maybe reading a customer's handwritten purchase order PDF. It's all generated within the company's walls, under its direct control. External data, on the other hand, is obtained from outside the organization. This introduces added complexities naturally. You have to consider the integrity of that external data source, its safety, and important legal things like copyrights or usage rights.
Like buying market research data.
Exactly. Think about Lisa buying market research data on local bakery trends or using publicly available economic indicators like inflation rates to help predict her future ingredient costs. That's external data. Now, beyond its origin, data can also be classified by its format, structured versus unstructured data. And yes, analytics can be performed on both, but they require very, very different approaches.
Structured versus unstructured. Or,
Yep.
okay, what's the difference?
Let's unpack unstructured data first. This is essentially all data that is not neatly organized in a predefined way. It typically stays in its original, unmodified format until it's actually transformed for analysis. The key characteristics are that it's not organized into predefined rows and columns like a spreadsheet, and its format or data type is often inconsistent.
So, messy data.
You could say that. It makes unstructured data quite difficult to sort and search using traditional methods. It often requires very different analytic techniques like natural language processing for text or image recognition for photos. Examples are everywhere. Think about social media posts, just free-form text, images, videos, or interview and phone call transcripts. Sensor data from the Internet of Things, IoT devices like smart thermostats or traffic sensors often comes in an unstructured stream of readings. Even videos or images themselves are considered unstructured data because their content isn't easily searchable by traditional database queries. You often find vast amounts of this raw, unstructured data stored in what's known as data lakes.
Okay, so that's unstructured. What about structured data?
Structured data is the opposite. It is highly organized, has consistent data types and formats, and is therefore easily searchable. It's the kind of data you typically find neatly arranged in spreadsheets, tables within databases, and more advanced structures like data cubes, data marts, and data warehouses. A key feature of structured data is its prominence in relational databases. In these systems, data is organized into records, which are the rows in a table, and each record has the same set of attributes, which are the columns.
Like a very organized spreadsheet, but more powerful.
Exactly. This consistent structure makes structured data easily searchable using query languages, like the very well-known structured query language, or SQL, often pronounced SQL. Structured data has several core components, especially when we talk about relational databases. You have tables. These are the main objects where data is stored, functioning much like a spreadsheet with columns and rows. Relational databases get their name because they cleverly combine multiple tables together through logical connections. Then attributes, or columns. These represent the characteristics or properties that describe the items in a table. Think of them as the headings in a spreadsheet: customer name, product ID, order date, records, or rows. Each row in a table contains all the information about a single entity or event. For example, one row might represent one specific customer or a single sales order for one of Lisa's sourdough loaves. And fields. This is the specific space at the intersection of a column and a row where an individual data value is entered. It's the smallest unit of data, like the customer's actual last name or the exact price of that sourdough loaf.
Okay, tables, columns, rows, fields. Got it. You mentioned relational databases connect tables. How?
That's where the magic happens. What really makes relational databases powerful are database keys. These are special attributes, special columns, that serve two main purposes. They either uniquely identify each record within a table, or, crucially, they facilitate the relationships between two different tables. They're the glue.
The glue. Okay. What types of keys are there?
There are three main types you'll encounter. First, the primary key. This is a required attribute in every table. It contains a unique identifier for each record within its own table. For example, a unique customer number or maybe even an email address could serve as a primary key for a customer table. It ensures every customer entry is distinct and easily identifiable. No two rows can have the same primary key value in that table. Second, the foreign key. This is an attribute in one table that contains values that are also primary keys in another table. This is how tables are linked.
So it connects them.
Exactly. For instance, a sales order record table might include a customer ID column. That customer ID in the sales order table is a foreign key. It refers back to the primary key, customer ID, in a separate customer details table. This links the sales order to a specific customer without having to repeat all the customer's details, name, address, etc., in every single sales order record they place. It's incredibly efficient, reduces errors, saves space. And third, sometimes you need a composite key. This is used in situations where a single attribute isn't enough to uniquely identify a record. In these cases, a combination of two or more attributes is used together to create that unique key.
Like using two columns together.
Precisely. For example, think about each individual line item on a sales order like one specific type of bread on an order that includes many different types.
Right.
To uniquely identify that specific line, you might use a combination of the sales order ID and the inventory ID for the bread type. Together, those two pieces of information make that line item unique.
Okay, primary, foreign, composite keys. Makes sense. And what was that term? Normalization.
Yes, normalization. This concept ties all this together, and it's fundamentally about reducing data repetition or redundancy. Normalization is a database design technique. Its main goal is to reduce data redundancy by taking large, potentially repetitive tables, like our example of a sales order table that also duplicates all the customer details for every single order, and dividing them into smaller, more efficient linked tables. These smaller tables are then linked together using those foreign keys we just discussed. A well-normalized relational database, through the effective use of these keys, is incredibly effective at reducing data redundancies for structured data sets. It makes data management much more efficient and, importantly, more accurate.
Could you give a quick example, like for Lisa's Bakery?
Absolutely. Imagine Lisa keeps a detailed record of every order at the Daily Loaf. Let's say she has 10 regular customers, and each customer places maybe 3 different orders a week. If she put all this information into one single giant spreadsheet, what happens? She ends up duplicating each customer's name, address, and phone number 3 times just for those 3 orders that week. Multiply that across all customers in weeks. That's a lot of repeated information. Very inefficient and prone to errors if a customer's address changes.
Right, you'd have to update it in potentially dozens of places.
Exactly. So normalization would restructure Lisa's data into much cleaner linked tables. First, she'd have a customer list table. This table would contain only one record for each customer, say 10 records in total, with their unique name, address, phone number, etc. Crucially, each customer here would be assigned a unique customer ID. This customer ID acts as the primary key for this customer table. Second, she'd have a separate product list table. This would hold all the details about each type of bread, pastry, coffee she sells, each with its own unique product ID as its primary key. And third, she'd create an order details table. This table would contain a unique order ID, its own primary key. Then importantly, it would use the customer ID from the customer table and the product ID from the product table as foreign keys.
So the order table just holds the IDs, not all the details.
Precisely. The foreign keys link back to the full details in the customer list and product list tables. So the order details table might just have order ID, customer ID, product ID, quantity, date. Much smaller, no repeated customer or product info. This whole process breaking down that original sprawling data set into multiple, smaller, cleaner tables linked by keys, thereby significantly reducing data duplicity. That is what we mean by normalization. It makes the data much more efficient, accurate, and easier to manage and query. Lisa could instantly see exactly how many sourdough loaves customer ID 001 ordered this month without digging through repeated addresses.
That makes so much sense. Okay, so we've collected our data. Maybe we've even structured and normalized it nicely in a database. But is it always ready to go straight to analysis then? It feels like there's probably a step missing, like having all your raw ingredients for a recipe, but they're still in their packaging. Some need to be chopped, others washed. We need to get the data itself in shape, right? Like preparing ingredients before you cook a meal. What are the essential steps for this data transformation journey?
You've hit on another crucial point. Raw data, even highly structured data from a well-designed database, is rarely ready for immediate, reliable analysis. There's almost always a preparation phase. The purpose of this data transformation, or data preparation, is to ensure that the data is complete, clean, current, secure, and ultimately user-friendly before any meaningful analysis can take place. This journey involves several critical elements. First, we absolutely need to ensure the completeness and integrity of data. Think about it. Anytime a data set is moved from one place to another, whether it's from an internal system to another internal system, or especially when we're bringing in external data, there's always a risk. A risk that some of the required data could be lost during the capture process or maybe mishandled or corrupted during the movement.
Data getting lost or messed up during transfer.
It happens. So it's absolutely critical to verify first that the data set you received is complete, contains everything you expected, and second, that its integrity remains intact. This means ensuring that none of the data has been accidentally or intentionally manipulated, tampered with, or maybe duplicated erroneously during its extraction and movement. If Lisa's trying to analyze her daily sales, but some sales records are missing or have been accidentally altered, any conclusion she draws will be flawed. Right.
Definitely. Garbage in, garbage out.
Precisely. Trusting your data's completeness and integrity is paramount before you do anything else. Second, there's data integration. This is especially important when you're sourcing external data, like those real-time foreign exchange rates for a multinational corporation, or maybe market sentiment data scraped from social media for consumer products. You need to design your data architecture carefully to ensure that this external data pipeline is seamlessly integrated with your target location or database. And it's not just about the initial load. You need to ensure that any ongoing updates from that external source are timely and accurately loaded into your system.
So it stays up to date automatically.
Ideally, yes. Without proper integration and updating, your data can quickly become outdated or fragmented, leading you to make decisions based on stale or incomplete information. Third, and perhaps one of the most hands-on steps, is cleaning or scrubbing data. After validating that your data is complete and its integrity is good, you still need to assess its quality. Often, data needs cleaning. There are generally 4 essential steps that should be completed to clean captioned data before analysis. 1. Remove unnecessary headings or subtotals. These often pop up in reports or spreadsheets that were originally designed for human readability, not for automated analysis. Imagine a sales report with a total sales for region A line halfway through.
Yeah, I've seen those. They mess up sorting and summing in Excel.
Exactly. Well, useful for a human reading it. These kinds of subtotals obstruct data synthesis or analysis tools from correctly interpreting the raw figures, potentially leading to double counting or other errors. So strip them out. 2. Clean leading zeros and non-printable characters. Sometimes data exported from one system to another might include extra, invisible characters or inconsistent formatting like leading zeros where they aren't needed, like 007 for a product ID when just 7 is sufficient. Removing these ensures consistency across data values, which is vital for accurate comparisons and calculations. 3. Format negative numbers consistently. Different systems might represent negative numbers in different ways. You might see a minus sign before the number 100, or maybe parentheses around it, 100, or sometimes even a trailing minus sign, 100. Standardizing this formatting ensures that numerical values are interpreted correctly across your data set, preventing errors in sums or averages later on. And 4. Identify and correct inconsistencies across data values in general. This is a big one. It's about standardizing entries that mean the same thing but are recorded differently. For example, if Lisa has a customer city field, New York might be entered as NYC, or maybe New York City.
Right, all meaning the same place, but spelled differently.
Exactly. If her analysis requires grouping data based on that attribute, say, to find out how many total customers are from New York, these inconsistencies will cause problems. They'll need to be replaced with a common, standardized value like New York City, so all relevant data points are grouped correctly for accurate analysis.
So consistency is key. Any other prep steps?
Finally, data encryption is often a necessary step, maybe even a required one, given the sensitivity and integrity requirements of most business data today. This typically means encrypting data both when it's in transit, as it moves across networks, like sending customer payment information online, and also when it's in storage, or at rest, on servers or databases, protecting it from unauthorized access if there's a breach. This adds a crucial layer of security to the entire data journey, protecting sensitive business and customer information.
Okay, makes sense. So once the data is complete, integrated, clean, scrubbed, maybe even encrypted, it's finally ready. But how do we actually make it understandable? We don't just stare at endless spreadsheets or database tables, do we? That sounds overwhelming.
Yeah.
This is where visualizations come in, right? To tell the story hidden in the data,
Yeah.
making complex information accessible and actionable. How does Lisa make sense of thousands of sales records without being overwhelmed?
Exactly. The efficacy of data analytics, how useful it actually is, truly depends on how well the insights can be communicated and utilized. And that's where data visualizations become absolutely integral. They take complex activities or high volume content, thousands of sales records, and transform them into easy to read graphs, charts, maps, or other visuals. This allows analysts, managers, even someone like Lisa running her bakery to quickly gain insights for decision making. They help answer critical business questions visually. What days are busiest? Which products are her best sellers? What caused those forecast variances in her ingredient costs?
So visuals make the insights jump out.
They should, yes. But when creating visualizations, it's not just about making pretty pictures. There are crucial considerations to ensure they genuinely aid decision making and, importantly, avoid misinterpretation. First, choose the right type of visualization. A pie chart, for example, is excellent for showing parts of a whole, like what percentage of Lisa's sales come from sourdough versus croissants. But it communicates vastly different information than, say, a scatter plot, which is great for showing relationships between two variables, or a line chart, which excels at tracking trends over time. Selecting the appropriate visual type ensures the message is clear and accurately reflects the underlying data and the question you're trying to answer. Second, apply correct scaling. This is vital, especially for axes on charts. Typically, the scaling on the y-axis, the vertical one, should start at 0, particularly for bar charts showing magnitude.
Why start at 0?
Failing to do so can dramatically exaggerate differences and lead to a misinterpretation of variations. It can make small changes appear much larger than they truly are. For instance, if you're charting profit and the axis starts at $10,000 instead of 0, a jump from $10,100 to $10,200 might look like a huge spike on the chart, when in reality it's a very minor increase relative to the base. Starting at 0 gives proper perspective. Third, utilize appropriate colors. Colors have a powerful psychological impact, we all know that, and they can greatly influence how a viewer interprets a visualization. It's important to consider your audience and maybe even their cultural context when picking a color scheme.
How so?
Well, certain colors might signify positive or negative outcomes, like red for losses, green for profits in some cultures. And using them inappropriately can lead to misreadings or unintended bias. You also want to ensure good contrast and accessibility for people with color vision deficiencies. And fourth, emphasize focus areas ethically. Visualizations can, unfortunately, be easily manipulated, sometimes unintentionally, sometimes not, to draw focus to specific outcomes or to present a biased view. It's paramount to ensure the visualization is designed purely to focus on the objective the data analytic procedure was designed to achieve, thereby avoiding any bias. The goal should always be clarity and accuracy, not persuasion through misleading visuals.
Good points. So assuming we make good ethical visualizations, how do we interpret them? Can you give some examples of those analytic techniques?
Yeah, absolutely. Combining the numeric statistical output with strong visuals often leads to the most actionable insights. Let's look at some examples. Regression analysis, as we mentioned, evaluates relationships between variables. Lisa wants to predict orders based on social media ads. The visual for this is typically scatter plots with the corresponding regression line showing the trend.
So dots on a graph with a line through them.
Pretty much. Each dot represents an observation, for example, ads versus orders for a given week. If there's a strong correlation, the dots will cluster closely around that regression line, or you'll see a high R-squared value, which measures how well the line fits the data. This allows an analyst to set expectations for future values and easily spot deviations that might need further investigation. If Lisa sees more ads clearly correlate with more orders on her scatter plot, she knows where to invest her marketing efforts. Variance analysis compares forecasted or budgeted values against actual results. It's a powerful feedback tool. A bullet chart is often very helpful here.
A bullet chart with that?
Think of it like a bar chart, but with extra context. It shows the actual value as a bar, but also includes lines or shaded regions indicating the target or budget, and maybe performance ranges like poor, satisfactory, good. This type of analysis provides feedback on forecasting capability, agility to respond to unexpected events, and indicates where you might need more analysis. For example, if you look at an actual versus budget bullet chart for J Company and you see the bar for cost of goods sold has shot way past the target line, that immediately signals an area for further investigation. Why did costs overrun?
Okay, bullet charts for variance. What about comparing time periods?
For period-over-period analysis comparing this quarter to last quarter, or this year to last year, bar or column charts are usually highly effective. They make comparisons very intuitive. This allows for a quick visual review and evaluation of gaps or changes between values across periods. Any significant differences or maybe divergent movements, for instance, if Lisa's sales bar is taller this quarter, but her net income bar is shorter, that should immediately call for further analysis to understand the underlying causes. Why did costs go up more than sales? And analysts would then drill down into related accounts to find out.
Makes sense. What about classification? Predicting categories.
Right. Classification is a predictive algorithm that uses historical data to categorize new data points, like recommending products or classifying customers. To visualize these results, scatter plots can again be useful, maybe using different colors or shapes for points belonging to different predicted classes. You can visually see if the classes form distinct clusters. To show the proportional makeup of populations by class or category, like what percentage of customers fall into the high spender class pie charts, or even better for more categories, tree maps are very effective.
Two mounts.
Yeah, they use nested rectangles where the size of each rectangle represents its proportion of the whole. Good for visualizing hierarchies or many categories at once. When interpreting a classification scatter plot, you'll typically see most observations gravitate towards one class or another. But often the anomalies, those data points that don't clearly fit with their neighbors, are the most interesting and should be analyzed further to understand what makes them unique or different. For example, a net income versus revenue scatter plot might classify years into low, moderate, and high earnings groups, visually showing how these relate to revenue, while a sales by state pie chart or tree map clearly shows the proportional contribution of each state to total sales.
Okay, classification visuals. And finally, trends.
For trend analysis, which is used to develop expectations of future results by comparing values over time, line charts are almost always the go-to visual.
Because lines connect points over time.
Exactly. They effectively demonstrate that forward-moving concept of time and make it easy to spot upward, downward, or stable trends. If you see trends in specific metrics that are inconsistent with your expectations or maybe deviate significantly from external industry data trends, further analysis is definitely warranted. For example, Lisa might look for trends in daily bread sales using a line chart to see if they spike on weekends or if a specific marketing campaign led to a sustained uptick. You can also analyze the variability or smoothness of that trend line. Maybe drill up or down into different time frames. Looking at quarterly or yearly views might show smoother long-term trends, while drilling down into monthly, weekly, or even daily views might reveal seasonality or abnormal patterns or the specific impact of short-term events.
This is fascinating. It really raises an important question, though. It seems like data can help us in so many different ways, not just looking backward at what already happened. Can you walk us through the different types of data analytics? It sounds like they kind of build on each other, moving from just understanding the past to maybe predicting and even prescribing the future. This sounds incredibly powerful, especially for a business like Lisa's trying to figure out its next steps.
That's a perfect way to put it, because data analytics indeed exists on a spectrum. It offers increasing value, but also increasing complexity as you move along it. There are generally 4 key applications or types, each answering a different kind of fundamental question, starting with the most basic. At the foundational level, we have descriptive analytics. This answers the question, what has occurred or what happened?
Just describing the past.
Exactly. This form of analytics is entirely backward-looking. It simply describes or summarizes past activity using historical data. Techniques here include observing basic summary statistics, things like minimum, maximum, mean, median, mode, count, sum. You might also sort data to reveal simple patterns or analyze data based on distinguishing characteristics like age group, geographic location, time period, or income level. For example, Lisa might use descriptive analytics to find out her total sales revenue last month, or the average number of croissants sold per day last week, or maybe how many customers bought more than 5 loaves in a single visit during the holidays. It's all about summarizing historical facts that are already in her records.
Can you give a more detailed example?
Sure. Imagine an accountant who needs to budget for doubtful accounts money they expect not to collect from customers for the coming fiscal year. Their very first step would be descriptive analytics. They'd research basic aging statistics for the company's outstanding accounts receivable. How much is currently 0 30 days old, 31 60 days old, 61 90 days, over 90 days. They'd look at the average percentage or dollar amount of outstanding receivables from the past year or two that eventually got written off. This tells them what happened regarding past collection rates and write-offs, providing the raw historical data needed for their budget projections.
Okay, so descriptive is what happened, what's next.
Moving forward along the spectrum, we get to diagnostic analytics. This level seeks to answer, why did it occur, or why did it happen? This goes a step beyond merely describing the past to try and uncover correlations, patterns, and relationships within a dataset to explain why a particular event or result occurred. It often addresses a specific question like, why did sales drop last quarter? Or why did a particular group of consumers respond so much better to that specific advertisement?
So finding the root cause.
Essentially, yes. Trying to understand the drivers behind the results. Common techniques here include drill-down analysis, which means mining deeper into the underlying, more granular data to find root causes. You might also perform cluster or profile analysis to find similar groupings within the data that reveal insights. For example, customers who buy product A also tend to buy product B. Correlation analysis helps determine if changes in one variable are statistically related to changes in another. Sequence checks can also be used to find unexpected gaps or duplication issues in results that might explain anomalies.
Can you give an example for diagnostic?
Let's say Lisa sees a sudden, unexpected drop in sales for her popular sourdough bread last month from her descriptive analytics. She'd then use diagnostic analytics to figure out why. She might drill down into her daily sales data to see if the drop occurred only on specific days of the week, or if it coincided with a particular baker being on leave, or maybe even with a batch of flour from a new supplier she tried. She could perform a correlation analysis between daily sales figures and maybe customer feedback scores collected that month, potentially discovering that a slight, unintentional change in the recipe coincided with decreased customer satisfaction ratings and lower sales for that specific bread. That diagnosis helps her fix the problem. Or, another example, if management for G Company sees their accounts payable balance suddenly spike upwards, they'll use diagnostic analytics. They might perform a correlation analysis between their vendors' financial statements, if available, and the timing of their own late payments to those vendors. If the results show that the vendors they're repeatedly paying late also happen to have high short-term debt ratios and decreasing operating cash flows on their own books.
So the vendors might be having cash flow problems.
Exactly. That diagnoses the likely common root cause of the spike in GE's payables. Their vendors' financial distress might be leading to stricter payment terms or issues. This allows G's management to address the underlying issue, perhaps by finding more stable suppliers or renegotiating terms, rather than just treating the symptom of high payables.
Okay, descriptive, what happened, diagnostic, why did it happen? What's next? Predictive.
You got it. Next on the spectrum is predictive analytics, which addresses the forward-looking question, what will occur, or what is likely to happen next. This is all about forecasting future data points or outcomes, transforming historical insight into future foresight, based on patterns found in historical data and using statistical models.
So using the past to predict the future.
That's the core idea, yes. There are several common techniques used here. Regression analysis is a big one. This uses a mathematical model to determine the statistical relationship between a dependent variable, what you want to predict, and one or more independent variables, the factors that might influence it. Simple linear regression uses just one independent variable, while multiple regression uses two or more. The resulting equation can then be used to forecast future values of the dependent variable. For example, Lisa might use regression to predict how many loaves of a new seasonal pumpkin spice bread she'll likely sell in October based on past sales of similar seasonal items, maybe local weather forecasts, and her planned advertising spend. Classification analysis is another predictive technique. This takes already labeled historical data points, example, customers labeled as churned or stayed, and allocates them into similar groups based on their characteristics. These groupings, or models, are then used to make predictions about which category future unlabeled data points are likely to fall into.
So unlike regression, which predicts a number, classification predicts a category.
Exactly. Regression predicts a specific numerical value, like $5,000 in sales. Classification predicts a category or class, like high-risk customer versus low-risk customer, based on predefined criteria learned from past activities. For instance, an online retailer might use classification to predict if a new customer browsing their site is likely to be a high-value spender or just a window shopper based on their clicking patterns and demographics, helping them target promotions. Decision trees are also used in prediction. These are useful visual tools that rely on the probability of different outcomes. They start with a single decision node that branches into multiple possible outcomes, and each successive outcome can branch further, resembling a tree structure. They help visualize and navigate complex decision paths with probabilities assigned to each choice, leading to a predicted outcome at the end of the branches.
Can you give a detailed example of predictive analytics in action?
Sure. Think about an electric power company that wants to project the number of power outages they might experience during the upcoming winter season. They could perform a regression analysis on, say, 20 years of historical data. They might find a strong statistical relationship between average fall temperatures in their region and the number of equipment failures leading to outages the following winter. Perhaps colder falls mean more stress on equipment. Using predictive analytics, they can then apply the current year's actual fall temperatures to their regression model at the start of winter to forecast the likely number of outages. This allows them to proactively prepare resources, schedule maintenance crews, and manage customer expectations much more effectively.
That's really powerful. Planning ahead based on data. Okay, so what's the final type of analytics?
Finally, at the pinnacle of the spectrum in terms of both value and complexity is prescriptive analytics. This tackles the most advanced question: what should occur, or what action should we take? This is about prescribing the optimal next course of action to actually achieve a desired outcome or objective, leveraging the probabilities and predictions learned from predictive analytics. It's truly forward-looking and explicitly action-oriented. It doesn't just predict what might happen, it recommends what to do about it.
So it tells you the best move to make. How does it do that?
It typically relies on more sophisticated decision support systems and optimization techniques. Key technologies include artificial intelligence, AI, and machine learning, ML. These involve self-learning adaptive computer models that can continuously improve their decision-making over time by analyzing vast amounts of data and outcomes. They can supply the most likely outcomes given any combination of complex circumstances, often optimizing decisions without needing continuous human input. Think about algorithms optimizing delivery routes in real time based on traffic and weather, or dynamically adjusting prices online. Scenario modeling, what-if analysis. This is also a powerful form of decision support. It allows users to explore different possible future scenarios and the potential outcomes of various decisions under each scenario. Probabilities can often be assigned to different outcomes based on predictive models. This helps decision makers understand the range of possibilities and choose the action that leads to the best expected outcome, or is most robust across different potential futures.
Can you give an example of prescriptive analytics?
Okay, let's imagine a large corporation planning a major international expansion. They need to decide which combination of new countries to enter would likely yield the highest long-term profits while also minimizing their overall global tax implications, a very complex optimization problem, especially since tax policies change frequently. They could employ a sophisticated what-if scenario model. This model would project a whole series of possible future tax outcomes in different countries, based perhaps on probabilities derived from historical tax policy shifts, economic forecasts, and current geopolitical factors. The prescriptive analytics system would then run optimizations across these scenarios to recommend or prescribe the specific expansion strategy, which countries to enter, in what order, maybe how to structure the subsidiaries, that is most likely to achieve their goal of maximizing long-term after-tax profits, given the range of potential future tax environments. It's guiding the best strategic decision. For Lisa, this might be a simpler but equally powerful what-if analysis. If she invests $10,000 in a new delivery truck, what are the predicted probabilities of increasing her catering sales by 10%, 20%, or maybe 50% over the next year? The prescriptive part comes in when the analysis recommends whether to make the investment based on which outcome makes the investment financially worthwhile according to her goals. It helps her make the best decision for her future growth.
That's a truly comprehensive picture of how data analytics evolves, from just observing the past with descriptive to diagnosing why with diagnostic, predicting the future with predictive, and finally actively shaping the future with prescriptive analytics. So what does this all mean for businesses and organizations out there in the real world? How are they actually putting all these powerful data analytics techniques to work beyond just these examples? Where do we see it most?
Oh, the applications of data analytics are incredibly diverse today. They touch almost every single aspect of modern business, all with the fundamental goal of optimizing decision-making and driving some form of competitive advantage. It's truly transforming how businesses operate across the board. One huge area is customer and marketing analytics. Companies use data constantly to build detailed consumer profiles, analyze purchasing habits and spending preferences, track responses to campaigns, and then use those insights to optimize their marketing strategies and product offerings.
With personalized ads and recommendations.
Exactly. It leads to increased sales, of course, but ideally also to a significantly improved customer experience through more timely offerings, personalized promotions, and relevant discounts that people actually find useful. Think about how streaming services recommend movies they think you'll like based on your viewing history, Or how Lisa might use her sales data to send out a personalized coupon for a type of pastry a customer bought once, months ago, but hasn't bought since, gently reminding them. It's all about understanding what the customer wants, sometimes even before they know it themselves, and delivering value precisely when and where it matters. Then there's managerial and operational analytics. These are often run in real time or near real time to help maximize efficiencies and production within an organization's day-to-day operations. For example, a large manufacturer might continuously monitor material usage rates and labor costs on the factory floor, allowing managers to make immediate decisions to optimize operations, maybe adjusting production line speeds to prevent bottlenecks, or quickly addressing unexpected levels of waste. Organizations frequently integrate these operational analytics directly into their key performance indicators, or KPIs, displayed on dashboards to track operational health and performance on an ongoing basis. This helps them identify and fix issues on the factory floor or in the service delivery pipeline before they escalate into major problems.
So, keeping the internal engine running smoothly. What about risk?
Absolutely. Risk and compliance analytics are incredibly crucial for maintaining integrity and avoiding costly penalties in today's increasingly complex regulatory environment. Organizations use analytics to continuously monitor their transactions and processes through techniques like continuous auditing, continuous monitoring, and automated reporting. This helps ensure that all activities adhere strictly to internal controls, contractual covenants with partners or lenders, and all applicable laws and regulations. This proactive approach helps identify and mitigate risks, things like potentially fraudulent transactions, data privacy breaches, or violations of environmental regulations before they escalate, potentially saving companies massive fines and, just as importantly, reputational damage. Financial analytics, of course, directly builds on much of what we discussed earlier in part one with the ratios. It allows organizations and financial analysts to monitor financial performance continuously, using data mining, ratio analysis, trend analysis, and forecasting models to track the financial health of the company, identify emerging trends, and make more informed financial decisions. It's about taking those raw financial numbers from the accounting systems and turning them into real-time dashboards and actionable insights that show the financial pulse of the organization, helping CFOs and finance teams decide on major investments, divestitures, capital allocation strategies, or managing cash flow.
And auditors use this too.
Oh, heavily. Audit analytics are now absolutely essential for the auditing profession, both internal and external auditors. They are used for several key purposes: more accurately assessing risk in an organization's processes and controls, providing greater assurance around certain operations or financial statement areas, establishing more objective thresholds and expectations for performance benchmarks, and crucially, improving the overall quality and efficiency of the audit itself. How? By allowing auditors to often test full populations of data rather than relying on just small, potentially unrepresentative samples. Imagine an auditor traditionally sampling maybe 100 invoices out of a population of 10,000. With audit analytics tools, they can now analyze all 10,000 invoices for specific anomalies, patterns, or exceptions much more quickly and thoroughly. This greatly enhances the depth and reliability of their findings and the assurance they provide.
That's a huge shift from sampling. Okay, any other major areas?
And finally, let's not forget tax analytics. Government tax authorities, large organizations, specialized tax accountants, and financial analysts all leverage tax analytics to help organize extremely complex tax information, laws, and guidelines. This helps improve tax planning and compliance, optimize tax strategies by identifying permissible deductions, credits, or optimal legal structures, and continuously monitor tax performance indicators to ensure accuracy and efficiency. It's really about leveraging data to navigate the complexities of tax law effectively, legally minimize tax burdens where possible, and ensure accurate reporting to avoid penalties. Hashtag tag outro.
Wow, what an incredible journey we've really taken today. We went all the way from dissecting those traditional financial statements using those powerful diagnostic ratios to harnessing the truly immense power of modern data analytics to uncover deep, actionable insights hidden within potentially vast amounts of information. We started with that foundation of traditional financial analysis, understanding how simple numbers can tell complex stories of profitability, liquidity, and long-term solvency for any business, whether it's a big company like G Company or Lisa's local The Daily Loaf. Then we leaped into the much broader world of data, exploring everything from the raw formats of structured and unstructured data to the meticulous essential process of cleaning and transforming it, and finally, how impactful visualizations can make that prepared data truly sing, giving you, the listener, a much clearer picture of what's really going on underneath the surface.
And We wrapped up by seeing how analytics isn't just about looking backward, is it? It truly empowers us to understand why things happened, diagnostic, predict what will likely occur, predictive, and even figure out what should occur or what action to take for optimal outcomes, prescriptive, all through those different evolving types of analytics. If we connect all this back to the bigger picture, what we've discussed today isn't just about crunching numbers or analyzing data streams in isolation. It's really about understanding the true narrative, the full story of a business, its past struggles, maybe, its current financial health, and its potential future trajectory. And this really raises an important question for you, the listener. How will you use this newly gained understanding, this toolkit we've unpacked today, to make more informed decisions in your own world, whether they're big or small? Perhaps it's applying some of these ratio concepts to your own personal finances, or maybe using this framework to better understand a company you're considering investing in, or even helping a friend like Lisa grow her dream bakery with a bit more data-driven confidence.
That's a perfect thought to leave you with. Whether you're assessing an investment opportunity, guiding a business decision at work, or just trying to make better sense of the financial news around you, these tools for understanding business health are truly invaluable. Thank you so much for diving deep with us today on the Deep Dive. We hope this empowers you to be even better informed. Until next time, keep exploring and keep learning.